Mortgage rates are still hovering near generational highs. And if you've been sitting on the sidelines waiting for relief, there's a strategy that might just get you off the bench. And no, it's not magic, but it's pretty close. We're talking about the 2-to-1 buy down, a tool that's been quietly gaining traction as buyers and sellers both scramble to make deals work in this frozen market. Here's the setup. Home prices haven't crashed the way everyone predicted, and yet affordability is at some of the worst levels since the 1980s. So we're stuck in this bizarre purgatory where sellers won't budge on price and buyers can't stomach the payment, and that tension is exactly where the 2-to-1 buy down was born. The way it works is almost elegantly simple. The seller gives you a credit, and that credit gets used to temporarily reduce your interest rate for the first 2 years of your loan. In year 1, your rate drops by 2 full percentage points. And in year 2, it drops by 1. So if your actual rate is 7%, you're living at 5% in year 1 and 6% in year 2. Think of it like a runway. You get a little extra altitude before you have to sustain full cruising speed. It's not a discount on the home. It's not a gift. It's a structured deferral that buys you breathing room while your income, your business, or your financial situation catches up to the obligation you've taken on. Now here's where most people zone out, and that's exactly when you need to lean in, because the math gets real in year 3. By the time that full rate kicks in, you need to genuinely be able to afford that payment, not theoretically, not optimistically, but actually practically, month after month afford it. If you can't, you're banking on rates dropping enough to refinance. And that's where this strategy starts to feel less like a plan and more like a prayer. And speaking of refinancing, let's talk about why that's not the victory lap most people think it is. Because of how amortization works, the first several years of your mortgage payments are almost entirely going toward interest, barely touching principal. So when you refinance, the clock resets, the bank celebrates quietly, and you go right back to feeding the interest monster instead of building equity. It's one of the most politely predatory features of modern lending, and almost nobody talks about it. So the 2-to-1 buy down only really makes sense if you either plan to be in a strong enough financial position by year 3 to absorb the full payment, or you genuinely believe rates will fall enough that a refinance becomes worthwhile. But even then, you should go in with eyes wide open about what that reset actually costs you. The strategy isn't flawed, but like any tool, it can absolutely hurt you if you're swinging it at the wrong problem. Historically, creative financing structures like this tend to emerge in exactly these kinds of high-rate, high-price environments. We saw echoes of it in the late 70s and early 80s, when rates were in the double digits and buyers were doing anything they could to make payments survivable. The market always finds a workaround, and sometimes those workarounds actually work, which is the quietly hopeful part of this story. The misconception you'll hear most often is that a buy down is just a gimmick sellers use to avoid lowering the price. And look, sometimes that's true. But in a market where sellers have legitimate equity and real incentive to close, a well-structured credit toward a 2-to-1 buy down can be genuinely more valuable to you than a nominal price reduction, especially when that lower rate in year 1 changes your debt to income enough to actually qualify. From a practical standpoint, the lesson history keeps teaching us is that it's not about timing the perfect rate or the perfect price. It's about buying a property that makes financial sense under reasonable assumptions and then managing your position with discipline. If the deal only works with the buy down and falls apart without it, that's a yellow flag worth examining before you sign anything. The emotional side of this is real too. There's something psychologically powerful about seeing a lower payment in year 1. And behavioral economists will tell you that present bias is one of the strongest forces in financial decision making. We overweight what feels good now and underweight what's coming later, which is precisely why you need to stress test year 3 before you ever get excited about year 1. The irony here is almost poetic. The very years where your payment is lowest are the years where you're building the least equity and paying the most interest relative to principal. And the year your payment jumps is also the year you've hopefully grown into someone who can actually handle it. The structure rewards patience and penalizes wishful thinking, which, if you think about it, is a pretty accurate metaphor for real estate investing in general. So if you're considering this strategy, here's the process that actually matters. Know your year 3 number cold. Have a credible plan for how you get there. Negotiate the seller credit aggressively. And don't fall in love with the lower payment so much that you ignore the full picture. Discipline and sizing, how much house, how much risk, how much cushion matter infinitely more than conviction or optimism. At the end of the day, the 2-to-1 buy down isn't a loophole or a lifeline, it's a bridge. And bridges only work if you know where you're trying to go. Build your financial foundation strong enough that year 3 feels like graduation, not a crisis. And you'll look back at this strategy as one of the smarter moves you made in a complicated market. Whether you're trying to find the right home, navigate the lending landscape, or figure out what renovations actually add value, check out our links in the description below, where we can help you get started with real estate investing, home contracting work, and finding the right lenders for your situation.